James Hardie Industries, ticker JHX, just delivered a massive top and bottom line beat for Q1 of fiscal 2027. We are looking at headline revenue that reached $1.475 billion.
Which is huge.
Yeah, it's up 64% year over year on a reported basis and up 12% on a pro forma basis, completely crushing Wall Street's $1.42 billion consensus.
Right, completely blew past it.
Exactly. And adjusted diluted EPS came in at 36 cents, which easily clears that Dora 32 cents consensus estimate.
Room to spare, honestly.
Yeah. And management didn't just, coast on the Q1 numbers either. They significantly raised their full year fiscal 27 outlook.
Right, would you love to see?
Oh, absolutely. So they're now targeting total net sales of $5.564 to $5.723 billion, which is well above that $5.4 billion street consensus. And they are looking at adjusted EBITDA of $1.536 to $1.625 billion.
And Q2 is looking strong right out of the gate too, right?
Yeah, exactly. Q2 revenue is guided strong at $1.485 to $1.575 billion. So naturally, the stock reacted positively. It ticked up 1.52%, and after hours traded to $40.82.
Pushing it right up near that 52-week high.
Exactly, as investors really just digested the ongoing AZEK integration along with this earnings beat. So for today's deep dive, we are pulling from the financials, the management commentary, and really trying to answer one central question. Is this company genuinely manufacturing its own success in what is basically a broken housing market, or
is that soaring valuation setting retail investors up for a pretty brutal reality check down the line?
Right.
And to really understand how they shattered these estimates, we have to look directly at the segment performance, like specifically how the legacy business performed alongside the newly acquired assets. Because that headline revenue surge, the 64%.
Yeah, it's blinding.
It is blinding.
Yeah.
But the actual health of the business, you find that by stripping away all the acquisition noise,
you
have to see how the core fiber cement business is functioning right now on its own.
Right, and breaking out the siding and trim segment gives us that exact baseline because this is the historical core of the company. And in Q1, it delivered $859.8 million in net sales, which is a 34% year-over-year increase on a reported basis.
Yeah.
But the metric that actually signals underlying demand is the organic growth. When you strip out all the acquisitions, net sales still increased by 20%.
Which is incredible.
It is. That kind of jump, that isn't just a byproduct of pricing power. That requires serious actual volume growth in North American fiber cement.
Yeah, and the volume growth is honestly the crucial mechanism here.
Right.
James Hardie isn't just riding some broader macroeconomic trend in home building. They are actively winning at the material substitution game.
Which is so important to understand.
Right, because when we talk about material substitution, we're talking about the physical reality at the job site.
Yeah.
Builders, contractors, they are systematically shifting away from traditional vinyl siding and those entry-level materials.
Oh, for sure.
Because fiber cement, it just offers a higher perceived value, better durability, and frankly, a premium aesthetic that lets builders command a higher price for the finished home.
Right, which ties directly into their strategic initiatives, right? Like the Common Plus technology and their expanded statement program.
Exactly.
They aren't just selling raw gray boards anymore. They are selling these pre-finished premium products. And by targeting the multifamily and the higher-end repair and remodel markets, they're insulating themselves from the entry-level single-family market.
Which is huge right now.
Yeah, because that entry-level market is just incredibly sensitive to mortgage rate fluctuations.
Oh, totally. And the repair and remodel resilience, that's carrying a ton of weight right now.
Yeah.
Think about it. A homeowner sitting on a 3% mortgage is heavily disincentivized from moving.
Right. They are not giving up that rate.
Exactly.
Yeah.
But they are highly incentivized to invest in upgrading their current property's exterior.
Yeah.
Right? Plus, to really understand this 20% organic growth, you have to look at the base effect from the prior year.
Oh, yeah. Last year was rough.
Q1 of fiscal 2026 was defined by severe channel inventory destocking. Distributors were aggressively freezing orders just to work down their own stockpiles.
Right.
So now that those distributor inventories have actually normalized, the ordering patterns have stabilized, the sell-in to distributors is recovering because that whole systemic bottleneck from last year has cleared out.
And that sets up a really fascinating contrast with the new addition to the portfolio, right? The deck, rail, and accessories segment, which is really driven by the AZEK acquisition. They posted $300.1 million in net sales for the quarter. But, and here's the catch, if you look at the pro forma numbers, simulating that James Hardie owned AZE a year ago just to get an apples-to-apples comparison,
Right.
sales for this segment actually declined by 5%.
Yep.
So on the surface, seeing a volume drop right after a major acquisition, that looks like a demand shock, right? It looks like a red flag.
It does.
But I look at it kind of like draining the pipes before turning the water pressure back up. Because if their end market sales are actually growing near double digits, a 5% drop in shipment volume means they're deliberately snarving the distributors to burn off old inventory.
Exactly. You nailed it with the training the pipes analogy.
Yeah.
The channel data completely backs up that dynamic.
Okay, good.
Draining the pipes was a totally intentional, planned reduction in production and shipments that management initiated late in the prior quarter.
Oh, so they saw this coming.
Yeah, it wasn't a failure to sell. It was a strategic move to align the inventory sitting in distributor yards with the actual end market demand.
Which is vital for working capital. I mean, a lumberyard doesn't want millions of dollars tied up in excess decking inventory.
Definitely not.
So by throttling back the shipments, James Hardie basically forces the distributor to sell through what they already have sitting on the lot.
And that sell-through metric, for you as an investor, that is the one you need to watch. Sell-through measures what contractors and consumers are actually pulling off the shelves, completely independent of what James Hardie is shipping to the warehouse.
Right, the actual final sale.
Exactly. And throughout the quarter, that end market sell-through actually accelerated. It was approaching double-digit growth.
Wow.
Yeah, it completely outpaced the actual shipments. Management even highlighted that retail sell-through was particularly strong, mainly because they've leveraged the combined James Hardie and AZEK platform to secure incremental shelf space.
That makes sense.
So now that the excess inventory is drained, the future shipments will have to closely match that double-digit end market demand.
Okay, so that intentional inventory drain clearly worked in North America, but looking at the international segments, it seems like they didn't even need to touch the pipes. The demand over there was surging organically.
Oh yeah, international's on fire.
Right. In Australia and New Zealand, sales grew 26% in US dollars, or, 14% in Australian dollars.
And the mechanism driving that Australian growth is low double-digit volume expansion. Yeah, they're securing direct builder wins, they're pulling market share away from alternative materials, and they're really benefiting from this gradual thaw in the broader Australian housing market.
Right.
And over in Europe, the story's pretty similar. Net sales grew 15% or 12% in euros, but the growth engine there is heavily reliant on their fiber gypsum products.
Yeah.
And that's coupled with very strong price realization across their entire European footprint.
Yeah, but, generating top-line revenue is really only half the equation, right? Especially in building materials.
Exactly.
Pushing a 64% revenue increase through a supply chain, while at the same time integrating a massive acquisition, normally that just wrecks operating margin.
Oh, absolutely. The friction alone destroys them.
Right, all the friction and overhead. But the margin profile in this report is, it's arguably the most impressive part of the entire quarter.
I would agree with that.
Total adjusted EBITDA hit $422.1 million, and that pushed the overall margin to 28.6%, which is a massive 230 basis point improvement year over year.
And expanding margins by 230 basis points during an integration phase, that requires some incredibly strict operational discipline.
Totally.
The legacy siding and trim segment really did the heavy lifting here. They pushed their adjusted EBITDA margin to 33.5%, which is a 140 basis point expansion on its own.
And to get 140 basis point margin expansion right now, when global freight and labor costs are still elevated, you need more than just favorable pricing to pull that off.
Oh, for sure. Favorable net pricing is a factor, obviously. But the real margin driver is the Hardie Manufacturing Operating System.
Right, the HOS.
Exactly, their proprietary framework for lean manufacturing.
Yeah.
When they push mid-double-digit volume increases through their existing factories, this operating system ensures they get maximum yield from their raw materials with, minimal downtime.
Which creates massive operating leverage.
Exactly. The fixed costs of running a giant fiber cement plant stay relatively flat, so every incremental board they produce at a higher volume falls disproportionately to the bottom line.
That's the beauty of manufacturing.
Right? And they paired that manufacturing efficiency with incredibly strict SG&A expense management, which essentially neutralized those localized spikes in freight costs they saw during the quarter.
Okay, so the siding and trim profitability is super clear. It's working. But if we pivot back to the deck, rail, and accessories segment, The reported numbers here actually present a bit of a trap for retail investors.
Oh, definitely. A huge trap.
Because the segment generated a 27.1% adjusted EBITDA margin, which translates to $82.8 million. Sounds great. But if you look at the GAAP financials, the same segment posted a GAAP operating loss of $3.3 million.
Yeah, quite the discrepancy.
Right. A $3.3 million operating loss suddenly becoming an $83 million profit isn't just a rounding error. I mean, could you quickly clarify how that operating loss pairs up with $82 million in adjusted EBITDA? Because that is a massive accounting adjustment heavily tied to the mechanics of the AZEK acquisition.
Right, so the bridge between a GAAP operating loss and massive adjusted EBITDA cash generation is almost entirely built on non-cash accounting charges. When James Hardie acquired AZEK, they didn't just buy physical factories, right? They bought intangible assets.
Like the brand.
Exactly. Brand value, proprietary manufacturing formulas, established customer relationships, and under generally accepted accounting principles, or GAAP, you were required to amortize, which basically means systematically write off the value of those intangible assets over their useful life.
Meaning it hits the income statement as a massive expense, which drags down the GAAP operating income. But James Hardie isn't actually writing a physical check for that amount this quarter, right? It's basically just a paper loss.
It is entirely a paper loss.
Got it.
Out of that bridge, $59.1 million was just the amortization of AZEK intangibles. Then you add in $21.8 million for standard depreciation and amortization, plus about $5.2 million in one-time restructuring expenses.
Okay.
When you strip all those non-cash and one-time items away, you are left with the $82.8 million adjusted EBITDA. So for an investor, adjusted EBITDA is honestly the far superior metric here.
Because it shows the real cash.
Exactly. It shows you the actual cash the decking business generated from selling physical products this quarter, totally stripped of the acquisition accounting noise.
And that cash generation story extends to their cost-cutting initiatives too, right? Because when the AZE deal closed, management promised some pretty aggressive cost synergies, and right now they are currently tracking ahead of schedule.
Yep, they're executing well there.
But even beyond the acquisition, they are seeing the structural benefits of closing the Fontana and Somerville plants in the previous fiscal year.
Right, those legacy plants.
Yeah. They targeted $25 million in annualized savings just by shutting down those older, less efficient facilities, and those savings are flowing directly to the bottom line exactly as planned.
And, optimizing the manufacturing footprint like that by closing legacy plants, it forces the remaining facilities to run at higher utilization rates.
Which means better efficiency.
Right, higher utilization means better fixed cost absorption, which loops right back to that margin expansion we just discussed.
It's all connected. The execution really is flawless. But, it raises a massive question about the macroeconomic reality they're actually operating in.
Oh, the macro environment is fascinating right now.
Right, because CEO Aaron Erter explicitly stated that this outperformance was not due to a shift in the underlying U.S. housing market. The operating environment is still hostile.
Very hostile.
Mortgage rates are high, affordability is incredibly low, and builder sentiment is super cautious. Yet, despite all of that, they are growing revenue by 64% and expanding margins.
Well, management is basically claiming they are successfully decoupling from the housing cycle.
Decoupling.
Yeah. Historically, building product manufacturers, they live and die by the macroeconomic tides of interest rates and housing starts.
Yes.
But James Hardie is attempting to manufacture their own demand curve.
And the mechanics of that decoupling seem heavily tied to their go-to-market strategy, right? They aren't just sitting around waiting for builders to call them. They are aggressively expanding nationwide partnerships with major regional distributors, like Boise Cascade, for example.
Right.
By locking in preferred status with those massive distribution networks, they basically ensure their products get priority shelf space and contractor mindshare, totally regardless of how many total homes are actually being built in a given zip code.
Exactly. That distribution dominance allows them to capture a larger slice of a shrinking pie. But there is also this really critical timing dynamic at play in the macro data.
What do you mean?
So when analysts look at the housing market, they usually look at housing starts, the number of new foundations being poured.
Right, the leading indicator.
Exactly. Housing starts are a forward-looking indicator, and they have been incredibly soft because builders are pulling back capital due to high rates.
But James Hardie doesn't sell foundations.
No, they don't.
They sell siding and decking, which are exterior finishes. You don't need siding for a hole in the ground. You need siding 6 to 9 months after the foundation is poured.
That lag is the absolute key to their current volume. James Hardie shipment volumes track much closer to single-family completions rather than housing starts.
Ah, that makes total sense.
Right now, the industry is just finishing the massive backlog of homes that were actually started 3 to 4 quarters ago.
Wow.
So single-family completions are holding up significantly better than new starts. So James Hardie is currently out there harvesting the demand from last year's construction decisions, which provides a really powerful near-term buffer against the current weakness in the leading macro indicators.
And that buffer is clearly generating serious capital. Management reaffirmed their free cash flow target of at least $500 million for fiscal 2027, which is a year-over-year increase of more than $200 million.
Yeah, and the mechanics behind that cash flow jump are actually pretty straightforward.
Okay.
The heavy one-time cash integration costs from the AZA acquisition that they incurred in fiscal 2026, those are rolling off.
Right.
So you combine the absence of those costs with the higher underlying profitability of the combined business, and your free cash flow naturally accelerates.
And they have a plan for that cash, too.
Yeah, they're deploying it with a very specific target, achieving a 2.0x net leverage ratio by Q2 of fiscal 2028.
And getting leverage down to 2.0x gives them tremendous balance sheet flexibility. But, if you are a retail investor looking at this stock today, the enthusiasm sort of cools off fast when you look at how the market is pricing all this execution.
Yeah, the valuation it's steep.
Right. A company operating this smoothly in a tough macro environment usually has absolute perfection priced into its shares. And that really brings us to the glaring risks in the bear case here, because while revenue surged by 64%, JAP operating profit only increased by 9.5%.
And that massive delta between revenue growth and operating profit growth, it just highlights the sheer weight of running this newly combined enterprise.
It's expensive.
It is. Yes, revenue is soaring, but the cost of sales climbed heavily to $925.9 million for the quarter. Taking on AZE means taking on significantly more operational overhead, higher structural liabilities, and just increased exposure to raw material supply chains. I mean, total liabilities for the company now sit at approximately $7.0 billion.
Carrying $7 billion in liabilities is, I guess, manageable when free cash flow is accelerating, but the valuation risk on the equity side is staggering.
It's terrifying, honestly.
Yeah, James Hardie is trading near its 52-week high, and the trailing PE ratio is sitting above 127.
That's just wild for a materials company.
Buying a cyclical building materials company at a 127 multiple is like buying a house assuming you'll win the lottery 3 years in a row to pay the mortgage. The market is pricing in absolute flawless execution forever.
And at a multiple that high, the margin for error effectively disappears. The stock becomes highly vulnerable to even the slightest operational hiccup.
It's just any little thing.
Exactly. If the long-term revenue synergies from the AZEK deal take, say, an extra 2 quarters to materialize, or if a sudden spike in freight or raw material costs compresses that 33.5% margin in siding and trim, the multiple will contract violently.
Oh, for sure.
Investors holding a stock priced for perfection are notorious for aggressive profit-taking at the very first sign of weakness.
So you are basically taking on significant execution risk precisely because they've optimized the business so heavily for the current constrained environment.
Exactly, which leaves you with a really fascinating structural paradox to mull over.
Okay, what is it?
Think about the strategic moves James Hardie has made. They intentionally permanently closed the Fontana and Somerville plants just to save $25 million a year.
Yeah.
They deliberately drained the distributor inventory pipes. They are running a remarkably lean, highly optimized manufacturing footprint that is printing cash while the U.S. housing market is essentially stuck in neutral.
But what happens if the macro environment actually flips? If mortgage rates drop next year and the pent-up demand for single-family homes is just unleashed into a true housing boom, the demand for siding and decking will skyrocket.
Yep.
So the provocative question really is, will a manufacturing footprint that was tightened just to save $25 million in a downturn actually have the physical capacity to handle a massive sudden surge in macro demand? Or will they find themselves completely caught flat-footed, unable to supply the market right when the real boom begins?
And that capacity constraint is going to be the ultimate test of their long-term strategy. Because draining the pipes works brilliantly for efficiency today, but if the floodgates open tomorrow, you have to ensure you still have enough pipe to catch all that volume.
We will certainly be watching the next few quarters closely to see how management balances that tightrope of lean manufacturing versus market share capture. Be sure to follow the show for your daily, no-nonsense earnings coverage.